A warm welcome to our guests tuning in from the US and in Singapore. Trust you had a great long weekend and break. We're live for another show with Moomoo. And this time, we've got a really exciting topic for you as we really round up the year and head into the next year, 2024. Once again, I'm your host, Olivia Higgins. But before we begin, here is a video just for you. So enjoy. Those who just joined us. Once again, you're here with us. I'm your host, Olivia Higgins. But before we begin, it's really about education today, okay? So let me remind you, don't take anything as financial advice or recommendations. Take this chance to network with the community members wherever you're tuning in from, and make sure that you ask those questions, okay? So our teams will be rewarding you for asking your questions, so keep them coming, and if they get picked, you'll definitely be rewarded more, and this is just our way to thank you for being here with us. Now, be ready to learn and be a part of the discussions, okay? Let's hop right in, everyone. We're in the final stretch of 2023, and 2024 is almost here. That's so quick, isn't it? Now, we're in the midst of earnings season, so let's dive right in. Today's topic is about decoding Q3 earnings and what you need to know today. So today with me, you certainly know him from Moomoo Technologies. Let's welcome Vice President of Strategy, Justin Zacks. Hi, Justin.
Hi, Olivia. Thanks for having me back on the show.
Always a pleasure having you here. Our audience loves you. Everybody does. So tell us about the topic of today. Why is it so important to pay attention to this quarter's earnings, just like the last show we had?
Yeah, so just like the last show we had, I want to talk a little bit about what's happened during this earnings season. We're, getting to the tail end, how everyone did and how that might inform your trading going forward.
Right. And for those people who don't know you, tell us more about yourself.
Sure. I'm the Vice President of Strategy, based in Jersey City, right outside of New York City, just across the Hudson River. And I've been in and around markets my whole entire life. As the Vice President of Strategy, I help identify risks and new growth opportunities for the company's online trading businesses while optimizing its existing business lines. And then the other part of my job is kind of what I'm going to talk with you about today. It's providing internal and external thought leadership about market dynamics, trading, and while doing that to inform you not only about the macro, but the micro, the earnings part of that, and kind of tying it all together in really helping people up level their trading.
Absolutely. I think up leveling that trading journey is what we're looking at, especially if we're starting the new year, right? I mean, the year has gone by so quick, but I think, Justin, we have done several shows together. Even the Singapore audience, they're very interested in the US market. So today, let's just unpack that a little. But I think today, well, let's go also a little deeper compared to our previous earnings shows, right? We want to try to figure out how they can re-strategize as the last few weeks come to an end for 2023. Now let's jump straight into it, Justin. So question one I have for you, what has changed since our last show in August? Let's start with the performance of the S&P 500.
Sure. If you look at the first slide here, what's changed since from the last webinar, which was on August 10th, to most recent data I have here on November 8th. I took a look at where the S&P index went, and it's down 1.9%. And then I went in and tried to figure out, which companies are leading and which companies are lagging. And if you look at the two leaders, one of them is Progressive, and Progressive is an insurance company. And insurance companies always fascinate me because there's kind of this cycle that they go through. And Progressive had really good earnings. It's one of the reasons it's up 26% over the period. 20% premium growth, which is just astounding. That's year-on-year number. And they're able to increase those prices irrespective of the people that are paying for insurance. So they're offsetting a lot of that inflation. I mean, inflation's running hot, but it's not 20% hot. And they really have that great pricing power. And a lot of times what happens with insurance companies is they get hurt by in previous cycles. So if you look at what happened with Progressive previously, there was all these natural disasters. Everyone remembers wildfires. There always seemed like there was a crazy natural disaster going on. There was soaring construction costs from the pandemic and a real supply shortage. There was labor shortages. And all these things haven't gone away necessarily, but they've gotten a lot better. And once they get a lot better, their claims costs don't rise as much as they have been rising. But meanwhile, they feel like they can push through the premiums because their claims costs were so big. So you saw this, this cycle for a lot of these insurance companies, and Progressive, obviously, well-managed company that was able to take advantage of that. And then, speaking of weather-related things, here we also have another leader, Energy, and they have a lot of electricity generation in the South, and it was really hot this summer, and so they did really well with some of this. Everyone turns their air conditioning on, and you always hear about these rolling brownouts. And these are the types of companies that got to keep the lights on and got to keep you at 68 degrees or I guess they're in Singapore, maybe about 20 degrees centigrade. They want to keep you cool, and it costs money to do that. And their revenues are going to go up, and their earnings are going to go up 24% on better than expecting earnings. On the opposite side, we have some of the laggards, and again, you have a different type of energy company here, SolarEdge Technologies, which really plays in the solar space, down 60% over the period. And interesting part, the last time we spoke 3 months ago, this was also on our laggards list. So this company has not done particularly well. It's down approximately 75% for the entire year. And I think there was a lot of hype over this company. They've experienced a lot of weakness in Europe, a lot of cancellations. And this is an overarching theme that a lot of people are looking at. Is the U.S. has done so well, and Europe has not done as well. And and there's a lot of questions on why that happened, and maybe we can unpack that a little bit later. And then we have Align Technologies down 44%, and those are they do the help you straighten your teeth. They have orthodontia that you put in your mouth and help straighten your teeth. And I think that might be something. Those are the types of things purchases people only make when they're absolutely sure they have that extra spending money, really discretionary purchases. And I think this may be a sign people are finally saying, okay, we're cutting back a little bit because our gas bill's going up. We're paying so much at the pump. We're food costs are out of control, so that they have to cut back somewhere. And maybe they could deal with crooked teeth a few more years. The interesting part is this company is headquartered in Israel, and they said on their earnings their poor performance is not necessarily due to anything that's going on with Hamas and Gaza. So nothing caused by that that's causing a disruption. It's more of just this overall consumer demand in the USA and in other areas that they operate. That's been the issue. And then if you look during the period, what happened to the S&P 500 overall, I said it was down 1.9%. And that's not really that much either way. But if you look at what happened, it was quite a wild ride. And it was down as much as almost 8% during the period. And then you just had this huge 6.5% rally. It was 8 straight sessions, and both the S&P 500 and the NASDAQ, that streak was something like hadn't happened in 2 years, I think, since 2021. So that, you don't see an 8-day up streak very often. And if you really want to talk, and that's kind of started right at the beginning of November, and there was 2 events that day on November 1st that really kicked that off. One was the Fed meeting, and honestly, the Fed didn't do too much. They didn't raise rates. They said they were, not planning on cutting rates anytime soon. And maybe there was a little bit of small changes in their language, but I think the market really interpreted it as saying they're done hiking. And it doesn't matter what the data says in the future, but although the Fed will always say they're data dependent, and that they're going to need to start cutting soon. And that's really hard to say that's going to be the case, but the market interpreted it that way. The other thing that happened is we had a refunding announcement. So every quarter, the U.S. Treasury has to sell bonds and bills to fund the U.S. government. And now, obviously, their funding costs are a lot higher than they were just a few years ago when they were, less than 1% in a lot of cases, or 2%, 3% in the long end. Now you're looking at funding costs near 5% across the board in a lot of the tenors. And people were really worried that the U.S. government would be selling a lot of long dated securities so that they would have to pay these 5% interest rates for 30 years or 10 years. And so what they found at this refunding announcement is they're going to sell a lot more short-term paper, 1 year, 2 year, 3 year, and not as much as of the long-term debt that was feared. And I think that helped allay a lot of fears. And you saw bond yields on long-term bond yields come down a little bit. They had been getting a little bit unhinged at some point, and people saying, well, no one wants to buy U.S. long-term debt anymore. There's just not the demand, and there's this huge supply from the U.S. government. And so I think there was a little bit rejiggering. And also I think a lot of the hedge funds had been on that trade, and they kind of thought, well, and they got caught short. And they had to cover their shorts, and we saw, but the moves, the swings in both the equity and the bond, but the bonds particularly, you're seeing 10 and 15 basis point swings on a daily basis. This is very unusual, very volatile market. So obviously anyone trading, whether it's stocks or bonds, anyone trading these volatile markets really has to be careful. Think about their position sizing, because you can have very large losses and very big wins very quickly, and you can see that very big win evaporate very quickly. So that's something to really think about. The other part that happened during that gain that we saw, that 6.5% gain, was a really huge crash in the VIX. And like I said, once the Fed came out, everyone was like, well, it's almost like they feel like the year's over. The VIX went from above 21 to below 15 in just that same time frame, about 8 days. With the idea that which I think is crazy. They're like, nothing's going to happen. There's all kinds of economic data. The Fed's going to meet again. We will have the tail end of earnings. These types of things, you got to have geopolitical concerns. You shouldn't pack it in if you're a trader for the end of the year. There's going to be a lot of opportunity, and there is a possibility to have, more of a downturn. Everyone thinks, oh, we're done, and the people are going to pack up and, go on holiday for, Thanksgiving here in the U.S. or, the Hanukkah, Christmas, New Year's. It's not done. We're not done yet. We're still got a month and a half left in the year. So, you have to look at that. And then if you look at the treasuries, kind of what they've done over that period, you see yields have come up. But particularly look at that 2-year from 484 to 493, and then the 10-year 411 to 449. And you can obviously see the long end has come up a lot. And that kind of during that period up until the Fed meeting, a lot of people finally took the Fed at their word and say, we are going to be higher for longer. The economy is doing very well. And these 4+% year yields are not necessarily going away anytime quickly.
Mm-hmm. Thanks, Justin, for that. I mean, you highlighted the key drivers. You looked at it from a macro perspective, but also, from the global stage. And I think a lot of the pre-live questions that we collated from the audience had to deal with, how they can manage the volatility going forward and what they learned from this round of earnings. But we'll settle that later on. Now, the next question. Now, Justin, what are your insights on the overall macro performance of the U.S. and global economy? Now, what's the analysis on your end? And what can investors over here, over there, everywhere look forward to?
Yeah, so if you look on my next slide, some of the observations I've seen since our last webinar on August 10th is what I talked about a little bit earlier, the economy. I mean, really crazy strong. I mean, really, economists haven't predicted this. Everyone I'm talking to here, on the street and in finance, very surprised. Fed's hiking so much, and what you're hearing from the everyday person, they don't feel the economy is growing at 4.9%. They're hurting, right? Like the inflation's hurting them, and they don't necessarily see big salary increases, and they don't necessarily feel better off. But meanwhile, the actual numbers in the third quarter, GDP grew at 4.9% versus a 4.5% estimate, and that's the highest reading we've seen since the fourth quarter of 2001. And obviously, back then, GDP was very influenced by a lot of the the stimulus that we had seen from the government due to the pandemic. So a little bit of those numbers were kind of inflated by all the money pumping, the $6 trillion that the U.S. government pumped in there. But if you want to, that was Q3. That ended September 30th, and here we are in November. So I want to look at, well, what happened in October, and we recently had the payroll numbers from the October month, and the unemployment rate rose to 3.9%, and that's against the 3.8% estimate. That's the highest reading since January 2022. I mean, historically, it's still quite low, but it has now gone up 0.5% from its nadir. So we're seeing a cooling labor market. And again, this is another reason that we saw a rise in the stock market. And I want to caveat that by saying, it doesn't make much sense. And as a trader, if you're thinking long term, you really shouldn't say, I want to go out and load the boat up on stocks because people are losing their job, because it's not really the way it's going to work. The economy will catch up to that, and it's going to work through the system. The immediate reaction is more on funding costs and on where the bond rates are, and this is why you would have a rise in the stock market on and news that's bad. So, but do be aware, these are short-term reactions and they can reverse. And if the unemployment rate continues to rise 5, 6, 7%, this is not going to be good for the economy, and ultimately that will not be good for stocks in the company's earnings, as we discussed. But meanwhile, speaking of those earnings, the future earnings growth expectations are increasing. So again, this is due to a strong economy. The S&P 500 earnings per share is now expected to grow by 6.8% over the next 12 months. That compares to in August, the last time we talked, 4.7%. And if you want to go back 6 months to when we talked, it was only 0.2%. So you can see now, everybody's was behind the curve, and I think everyone was waiting for the economy to crash, or at least fall into a moderate recession. And when everyone thinks something's going to happen, that's usually when it's not going to happen. And so I think that's what we've definitely seen here. But now the expectations may have gone a little too high the other way. So we're seeing now people are expecting a lot of growth. I mean, it's close to 7% growth. That's pretty good. So that's going to be I think that's going to be a higher bar for some of these companies to beat. Doesn't mean they can't do it, but we will see. And but there is that expectations is now kind of priced into a lot of these stocks. So traders do need to think about that. We're getting close to those 52-week highs and all-time highs in a lot of these markets. I mean, and you just felt like we just sold off, but we're getting back close to the highs, and it's only been a 2-week rally here we have going on. So we'll see how we move into the end of the year, and if we can break through those all-time highs and maybe push higher, or maybe that will serve as some type of resistance, and these expectations of 7% growth might not come to fruition.
Mm-hmm. Thank you for the comparison and also the overview on this. And, I think your insights really add value because we already have a lot of questions coming in. Now, keep them coming, everyone, because we're giving away points if your question gets chosen. Okay. Now, Justin, you highlighted also the different time horizons and also what investors should look out for and also be wary about when they do decide to make that personal decision. All right. So with that, now we've set the context, we've seen the progress, since the last earnings season. Now, what are some of the key findings that we can learn this time round? And have we exceeded? I mean, let's take it from the last comment that you mentioned about the expected earnings.
Yeah, and I would say it's really been a mixed picture. I mean, overall, it's been good. And if you look at my next slide here of the earnings season review as of November 8th, 88% of the S&P 500 companies have reported. We still have a few big ones left, but most of them have reported. 82% have reported better than expected earnings, and that compares to 81% the last time we talked. So the earnings are still coming in strong. And if you look at the sectors, the best sector is communication services, and if you want to look at some of the companies in that, I'm thinking of Netflix. Think about how well Netflix did compared to expectations. I mean, people had written them off for dead, and you had a writer's strike, and there's no way they could add a lot of subscribers, and so I think they really had low expectations. They beat that subscriber mark really well. You've seen one of their competitors, Disney's killing it too. They're doing really well. So you see some of these companies do very well in their earnings. And then on the downside, we've really seen some of these interest rate increases hurt the real estate sector because of the funding. Not only is it harder to fund, it makes it less profitable, but a lot of the transaction have dried up. If you look at residential real estate, I mean, we're at multi-year lows with homes trading between people. Like, people aren't moving because they're already locked in. Prices are still very high, but for a company, say like Zillow, to make money, brokers to make money, real estate brokers, there has to be a transaction. If no one's buying or selling, they're not going to get their commission. So the companies that work on a brokerage model in the real estate sector are not going to do well. On top of that, we recently had this court decision that really hurt a lot of these companies. So I am keeping my eye on a lot of these real estate companies to see how they do. They're a good barometer for a lot of other things that are going on in the stock market and in the economy in general. Now, if you want to look on the revenue side, not so good. 49% of companies beat revenue estimates. That compares to 58% the last time we talked, so down a lot. And that 49% number is the lowest number since the third quarter of 2019, when we were deep in the heart of the pandemic, right? So we are seeing some slowing on those top line numbers. And if you want to look at the best and worst sectors, 64% of consumer discretionary companies beat estimates. And that's very interesting. And this is what I'm talking about, the mixed picture. I'm getting this mixed picture of Align Technologies is not doing well. Consumer discretionary, people are holding back, but other places are doing well. People are, they're out there traveling. Olivia, I heard you might be traveling soon to visit us here in the States. Is that true?
Yes, it's a surprise, everyone. Stay tuned for that. We have so many exciting things upcoming. Can't wait, Justin.
Yeah, so Olivia is going to be coming out to join us, and we're going to be having an event. And obviously, everyone that's watching this, we want you to have the chance to come join that event. So please look out for your emails and in your inboxes. We're going to have a really exciting time when Olivia comes and joins us here in New York for a few weeks.
Yes, I'm going to enjoy the winter as well.
Yes, and for anyone in Singapore, you get those nice degree days here in New York. It's really quite nice, and we'll show you Olivia bundled up in a nice coat and still
Yes.
probably be quite cold.
I'm sure our audience is waiting for that moment. So
Yeah,
yeah, I mean
we'll
the
make sure to get
traveling.
her out in the nice snowstorm or something really fun, really New York.
Yes, I'm counting on you, Justin.
And then
Sounds
for
good.
the
Yeah.
for the worst sector, you have utilities, and a lot of that, again, we're always talking about the weather here, and certainly utilities are always influenced by
Mhm.
the weather, and we have seen some issues of lower demand in certain sectors. We did see, obviously, we saw a heat wave that caused some of the companies to do well, but some of that lowers your heating costs. So if we continue to have a warm winter, their revenues don't necessarily do as well because people don't need to heat their homes to the level when it's already so warm outside. So yeah, so really interesting review, and like I said, very much a mixed picture as to
Mhm.
what went on. It could take, there's a lot of different things to take from this season.
Mhm. Wow, thank you for that comprehensive summary for our audience members. We have a lot of questions coming in. Yes, keep them coming because I'm already choosing them. Now, Justin, many users in the pre-live announcement, they asked about this. Now, here's a burning question for you. What was the overall stock performance, and what should investors prioritize as a key takeaway?
So yeah, so some of the key takeaways, if you look at my last slide here of the stock market performance during earnings season, and basically that's measured from when JP Morgan kicks off the season. They're traditionally the big money center bank that starts the earnings season by reporting first and then going through to November 8th, the most recent data that we have. S&P up 0.8%. And again, we're talking about this wild ride. And so and it's interesting, as we've seen before, the S&P has done moderately well during earnings season. It's not killing it, it's not tanking, and I think people are waiting for the shoe to drop. The shoe hasn't dropped yet, and we continue to chug along. And sometimes we do obviously have some of these macro influences during earnings season that are contributing to up or down overall. But you got to get down more to the sector and company level, and on those sector level, you see leaders, consumer staples. Were up 3.8% on average over that period. And again, these are the types of companies, you need to eat your food. They pass along, you need the diapers, you need the toilet paper, you pass along the costs. And so they're still able to pass along those costs, still doing well. So people are not necessarily cutting back on the stuff they absolutely need to have. And those are the consumer staples. And then the utilities have done well. And that's another interesting part, because that was a little bit more mixed because the revenues weren't necessarily as good, but I think that maybe they got their funding, where they needed to be. So there's other factors there that roll into how well the utilities did. On the laggard side, we've seen energy not do so well, and that may be a sign that a recession may be on the way, or at least a slowing of the economy. And when you see a major geopolitical event like we've seen
Mhm.
in Israel, and you see oil go down after a few weeks, it's a real sign that there's just not the demand right now
Mhm.
for oil. And if that's the case, that usually precedes a economic slowdown of some type. So we'll see what happens. And it doesn't always happen.
Mhm.
And then on the other side, we saw industrials down 1.3%. Again, not a big move either way. And you're just seeing some mixed picture. And again, these are economically sensitive areas, industrial. So again, this may be a precursor of maybe there's a slowdown, or more importantly, traders think there may be a slowdown. And like I said, they've thought that for a while. So it still hasn't come there. And will Q4 be the earnings recession? It's not predicted to be. We've seen estimates come down maybe 4%, which is really not too much. Usually estimates come down about 6% after earnings. So the other really interesting part about this earnings season was overall stock market went up a little bit, but if you didn't do well, it's a stock pickers market. If you don't do well, you're going to get punished. And we saw companies that reported negative earnings surprises, meaning their earnings were less than what the street thought they would be, they're being punished more than usual. And obviously, they're always going to drop. And over the last 5-year period, they dropped 2.3%. But this quarter, we've seen an average price decrease of 5.2%. And the way this is measured, this is from FactSet, 2 days before the earnings release through 2 days after. And that's actually the largest negative price reaction since the second quarter of 2011. That's 12 years ago. So obviously, that's something that you really need to watch about. We still have a few weeks of earnings left. So think about that when you're trading these earnings stocks, right? If they miss, the stock could really go down. So,
Right.
be aware of that. And that's a risk that is bigger than it is usually. And it's something to think about. The other area that I want to talk about, and obviously everyone wants to talk about, is, these magnificent 7 stocks and how they did. And we saw a little bit of those negative reactions with some of those stocks. So think about the stocks that did really well and beat earnings and did fabulous. So you have Microsoft up 3.1% the day after earnings, Amazon up 6.8%. Those are the two that beat and went up. And then we had 3 that beat and went down. Apple down 0.5%, Meta down 3.7%, Google down 9.5%. And then one company missed, Tesla, and the company that missed obviously down the most, 10.2% decrease. This is just a 1-day decrease. These are big numbers. And then the last of the Magnificent 7, Nvidia has yet to report. That's going to be November 21st. That's a great date to look out for, a great stock to trade. So, you can use the Moomoo app to get a great preview of all of the upcoming earnings, including the video. We have a great calendar that shows you a lot of the hot stocks that are going to be reporting today, tomorrow, and into the future that you can look at on a calendar basis. Really plan your trading ahead. Say, I want to be trading this stock during earnings, or I want to stay away from it. However you like to trade, and then you can get down in there on the company level. Look at that stock and say, I want to see how they've done in the past fundamentally. And then once the earnings come out, you can review the transcript, you can review the earnings release, the SEC filings, all those things. So important when you just don't jump in there and start trading the video. You don't even understand what's going on. You really need to read those earnings reports, listen to the commentary from the analysts, questions that they're asking the executives. So much important knowledge to gain from all this information to inform the fundamental and even the technical analysis going forward for a lot of these companies, not only on the day of earnings, but in the near future over the next quarter and into 2024.
And also watching shows like these, really tuning in, connecting with the community, making sure that you even watch the replay of this if you missed out on anything that Justin mentioned in terms of the analysis, whether it's macro or how you can apply it. Now, I think some really important points there, Justin, but really, I think rounding up our discussion here, because we got a lot of questions coming in, I want to leave the second half of our live webinar right here for our user questions. Really, really good questions coming in. So thank you for that. Keep them coming. So rounding up our discussion, Justin, why is it important to keep track of the previous earnings seasons and the current one? But I think more importantly, what are the practical steps that our investors tuning in right now can possibly do to move forward?
Yeah, I think a lot of people are like, well, why should I care about something that's already happened?
Right.
Because it's already happened. I should only look to the future and what this company is going to do in the future. But the past can inform the future, and you really have to understand what the company is doing, and obviously how the company did influence its cash levels, influences its stock's performance. So that those numbers are not public; they're being made public. You have to interpret them and say, if they made a certain amount of money, how does that influence the value of the stock? You have to determine that, and that's what you do as a trader. So that's why it's so important to watch these earnings. But beyond that, it's figuring out what that future is going to be. So you have to see where they are. if you don't know where you are, you don't know where you're going. So you have to first really understand where a company is before you understand where they're going forward. And even the earnings themselves have a forward look. A lot of companies give guidance. A lot of companies give color on not only how they did, but the outlook for their company, their sector, the economy overall on conference calls. I'm a huge fan of conference calls. I think that's like one of the number one things that traders can look to really understand where the market's going.
Thank you, Justin. And I've picked some questions over here from our pre-live and also our current live questions. But before we begin that, here's a short video just for you. And we're back. Once again, you're on Decoding Q3 Earnings. Here's what you need to know today to go forward as we go into the new year very soon. We're on air with VP of Strategy, Justin Zacks. Now, Justin, I've picked the first question from our pre-live, our users. They've got these burning questions. The first question: prices have been dropping on a wide spectrum of stocks despite the strong earnings reports that you covered. So my guess is this might have been something to do with the debt equity ratios of these companies and perhaps the anticipated interest rate increases. So what is your research and insights on this?
Yeah, that's an excellent question. And I think a lot of people really don't realize how narrow this rally has been. I mean, we've had a great rally in the S&P 500. I don't know exactly 15-16% this year. NASDAQ's up 30+%. Yet, if you want to look at an equal weighted basket of the S&P 500, not up much. The Russell 2000, which includes 2,000 of the smaller stocks, is closer to flat for the year. And so a lot of this has to do with the company's debt profile. So we've seen this huge increase in interest rates, but a lot of the companies have benefited from this. And you say, well, how could that be? So what they did, if you think of a company like Microsoft or Apple, they issued debt very close to where the U.S. government issues it. They're considered almost as safe, or if not safer, particularly if you look at the negative outlook that's been slapped on the U.S. government recently. They may be safer than the U.S. government. So they fund at very low levels. And so what they did during 2001, when we were, at 1-2% interest rates, they took out, they issued a lot of debt. And so they have a lot of cash on their balance sheet. Now they have that cash earning 5%. So they've actually had a huge benefit. And a lot of people thought, well, eventually that debt will roll off. But their maturities cliffs are further out. So it will take a long time for those. So they're in a good position. And those are a lot of the big companies that with the really great credit ratings, anything you would consider investment grade,
But the companies that are highly levered and needed to borrow a lot of money, not only they're borrowing at higher costs because their credit rating is not as good, but a lot of their debt, they weren't able to issue it during that period, or they issued short-term debt, and that debt's rolling off, and they have to refinance it. And now they're refinancing it, they can't get 5%. They're refinancing much higher at junk levels, 7-8+%. And so that's going to have a huge impact on their stock because they have a much larger interest expense than when they were funding 5% lower. And this was just 2 years ago that we were at negative interest rates in a lot of cases across certain products. So that's kind of where that's going on, and it's leading to this bifurcated market. I mean, eventually, depending how long we stay at these rates, other companies will start to see the pinch from this, and this is where it could get dangerous for the overall stock market, because some of those 1, 2, 3, 4-year debt is eventually going to start rolling off, and if companies want to grow or do some type of capital spending, they're going to need money. And if they need the money, if they don't have the cash available, they're going to have to go to the debt markets. And recently, when we saw some of these interest rates come down, there is a demand that, and right after that Fed meeting, some of these interest rates come down. Corporates went right to the market to try to get some of this lower cost funding that came down 30, 40, 50 basis points.
Thanks for that. Next question, Justin. What's your take? Because we covered the big companies here. What's your take then on the mid-sized stocks performance in the next quarter?
So it's really interesting. That's, again, to me, very tough because a lot of them have been really beaten up. So relative to some of these larger companies, like that spread hasn't been this wide in quite a long time. So I mean, to me, it's really going to be a stock by stock type of thing. And I think there are some gems out there. And this is, again, great chance to use your Moomoo app and run some of those screens. I love some of these screens to try to find some of these really good value stocks, because although, some of these companies are in a precarious position, but they're so cheap because on a valuation metric. So if you have the time to wait around and you have that, the gumption to wait through a possible recession, there's some good values out there. Other ones, not so much. There could be some, quote, value traps, and you have to do your research around some of that. But definitely, I feel that there's some opportunity in some of these mid-sized companies that have been overlooked because everyone has piled into all of these mega caps, and at some point their valuations have gotten very extended, and there's only so much higher they can go unless we just continue to blow the lights out on these economic numbers.
I mean, speaking of that, the next question then would be on technology. So we have a lot of questions on this for both pre-live and the current live right now. So let's summarize it into one question. The US stock market has risen a lot in the past 2 weeks. Now, what are your insights on technology stocks? And is there still a chance for it to rise again before we hit the end of the year?
Yeah, so I think a lot of that, again, it's so interesting because people are piling into these technology companies because they feel they're somewhat insulated from interest rates on this funding side. But on the other side, obviously, a lot of their earnings are well off into the future, meaning higher interest rates really hurt the present value of their stocks. So my thought on that is if interest rates continue to climb into the end of the year, these stocks are not going to do as well. But if we do see an abatement of those interest rates, you really have to think about what's behind it, right? If a really bad economy and bad employment situation is pushing rates lower, that's not necessarily good for tech companies. Like, people are going to just be out purchasing less things. But if it's just kind of a slow move based upon expectations of the Fed, that's the type of situations that you can see these tech stocks continue to rise towards these 52-week and all-time highs, and you can really have a seasonally, we're in a really good spot for a lot of stocks. December's generally one of the better months for stocks. So people want to be long stocks going into the end of the year. So you could see that continued increase. But look, I mean, you do look over this last 2 weeks, it's been quite a run. So, and that's why I think it's very important to, the real flagship is going to be NVIDIA, and that's a week from today. And so I'll be really looking at NVIDIA to see how they did, and not only how they did, look at the price reaction of NVIDIA to how they did. If it's down and they had really good earnings, that might portend, a cooling off of the tech sector going into the rest of the year.
Right, as you mentioned before as well. Thank you for that. Now, the next question then, more tech questions, but you're looking at the AI sector and how it will evolve and how it is evolving, particularly, for example, even Tesla and Neuralink, the different uses of AI, just as an example. Now, how do we make sense then of both the earnings and other news, such as, the layoffs within the tech giants?
Yeah, so I mean, you have to really take the layoffs with a grain of salt in terms of a lot of these are headlines, and a lot of times the layoffs came after significant hiring. So if they hired 500,000 people, they're laying off 50,000 people. You have to put it in perspective and saying, why are they laying off? I'm more interested in what reason they're laying people off. Is it just this natural attrition? Or are we saying we are having a very bad outlook going forward and we need to lay people off? That's the type of situation that you have to be wary of. And so you just can't say, oh, look at a number in a vacuum of a number of layoffs for these tech companies. And on the AI side, obviously that continues to be, I think, a longer term play. I mean, AI is really in its infancy. And I think a lot of people have gotten overly excited to think that some of these companies are going to see immediate results on their bottom lines from AI, starting today, and that it's going to be massive. This is going to be a decade-long development. If you look at, the previous technology that really changed everything, the internet, and you took how long the internet, and we're still seeing gains today with the internet, but it just didn't, the internet gained popularity in the the mid 90s, and it really took quite a while for it really to ramp velocity in terms of production in revenue increases, and probably even after the tech crash. We're really talking all the way into 04 and 05 when it really started to really capture it, almost a decade later. And so that's how I think about AI in its implementation into a lot of companies. It's right now, it's just an assistant, right? Like people are using it. It's kind of almost like a toy that people are using. Oh, what can I do with ChatGPT? Like,
right.
But it's not always going to be that way. It's really going to evolve and become the major feature for a lot of tech companies, and it's going to drive a lot of earnings. But but we don't know where that's going to be and which companies. I mean, probably some of these companies are not even born yet that are 10 years from now are going to be champions of AI.
I mean, other examples would be even quantum computing, or even how they're experimenting with flying taxis in New York soon, right? There are all these things that are out there in the news. So definitely for the investors out there, just try to look past all these buzzwords and look at the fundamentals, as Justin highlighted. Look at the research and make sure that you make an informed decision before you jump on the bandwagon. Okay, next question, more macro trend, still on the top 10 tech companies, but now this user would like to know, since we touched on the smaller companies, how will that affect them as well? So there is the current trend of the S&P driven up by these top 10 and more tech companies. So what does this mean for the smaller companies that I would like to invest in? Is there more room to grow? What is the potential here, Justin?
Yeah, so I mean, I talked a little bit about this before in terms of, if you want to look at the real small companies, I always think about what is going to be their ability to compete, right? So a lot of these companies, the small companies, I'm really want to look at what their cash position is. That's really important, and it's really overlooked, because small companies that have cash are in a very good position, because they don't have to go out and beg people for money to fund things. And in this environment, funding is a lot more expensive, and it makes it a lot easier to compete against these big tech companies. And I mean, a lot of these big tech companies are almost monopolies in the way they do things, and they have vast economies of scales, and platforms are so important in so many tech sectors. So small companies have to find a way to differentiate themselves. But the good part is, small companies have that growth ahead of them. They're quick, they're nimble, they're usually more innovative in so many ways. So there are so many opportunities in that small cap space. And that really is on the user, is on that end Moomoo user to find those companies, identify them, the ones that are going to do well. And again, I would love to use the screeners and read the transcripts. But the other great part about looking at the small companies is a lot of times they're overlooked by professionals, right? So they just don't have enough time to follow 5,000 companies. So everyone knows to the T exactly all the metrics behind Tesla or Amazon, but these small companies, it's a great chance for the everyday retail investor to really find something interesting about that company that may lead to growth in find an undervalued investment. So that's where your homework comes in. That's where the research comes in, and that's why small cap investing, if done right, can often outperform a large cap.
Thanks for that, especially that last point. Really, really important. Now, next question. Of course, we're talking about the US market, and we cannot talk about it without talking about the election year for the US next year. So is it time for investors to plan? And what are some possible strategies they can look at for medium and long term? What would you say are your insights and guidance points for this, Justin?
Yeah, I feel like the U.S. election cycle is like no other country. I mean, it really kicks off 2 years in advance. It's really funny because, it's the same thing. It gets earlier every year, just like, right in New York now. I just went to this restaurant the other night, and it's all they do is play Christmas music. It's
yes.
early November, and it's as soon as November 1st, we have all the office decorations, they're all set up for the holiday season. So soon as because retailers just want to make this season even longer, and for this politics, at least on the business side, it's all about advertising, right? The amount of advertising that is spent during the political season is astronomical. So you certainly want to look to some of these big advertising companies like like Alphabet and some of these other ones that will benefit from all of that ad spending. But it's really still very far in advance to predict who's going to win the election or who even the nominees will be. I mean, you're really still talking an entire year away, and that part of it will affect some of the sectors. Certain sectors may or may not do better under a Republican or a Democratic administration, but overall, you still have a very dysfunctional Congress. So no matter which party takes the executive branch and becomes the president, it might not matter too much because you have a lot of gridlock in Congress, and that's more of a worry on the funding side. And this is something we've seen Janet Yellen come out recently and say, we don't have a funding problem. The U.S. Debt should not have been the outlook should not have been changed, and so the U.S. needs to take a hard look at the amount of money they're spending and can spend, particularly when the economy is running so hot. Why are these deficits so high? And what's going to happen if we fall into a recession? Those deficits could widen, and it could be a problem for the debt market, and it could be a problem for the stock market. So, going into the election, it's always crazy to think of. And the other really interesting part of it is there's a lot of seasonality that goes into stock market performance during presidential cycles, and it's very interesting. So we here at Moomoo will be launching a podcast just to let everyone know that will go live tomorrow, and we kind of have 3 different episodes, and one of those episodes, and I'm the speaker on these podcasts. One of those episodes is about stock market seasonalities. So if you are a user that wants to know about the January effect and which months are better or worse for the stock market, kind of all these seasonal patterns, what happens around holidays, tune into the podcast, and it's going to be on Apple and Spotify, and we will also have it on our own website at Moomoo, launching tomorrow and every Wednesday thereafter. We'll be talking about stock market seasonality. We'll be talking about 2-day shipping and the holidays. I will have a special guest, secret special guest that will talk about Gen Z investing. So please look out to the podcast coming tomorrow.
Oh, that's great. Stay tuned for that, everyone. And of course, Justin, I think that is really exciting news. And what you mentioned, this is definitely just the start, right? We can do even an extender because we have so many questions on this topic, on seasonalities. So definitely something you want to watch out for tomorrow, everyone, for the US side. So next question, and I'm going to wrap up really quickly here. We've got just one from the pre-live, and I'm going to pick out one more from the actual live right now. Okay, so from our pre-live, someone would like to know, could you explain, Justin, the relationship between how the stocks don't rise during good earnings, and how does that make sense for an investor that they might
and so
have
I
an
talked
opposite effect? Yeah.
Sure, I talked a little bit about this before with the Magnificent Seven and how they did, and overall the companies tended to beat the earnings expectation. I think, like I said, I think it was 82%. So you have to think about that number, right? It's not a 50-50 proposition. So if it was 50-50, a stock could have equal chances of going up and equal chances of going down. So that's really what you want to think about. So the expectation should be about how much they're able to beat earnings by. And it's always not just about the earnings. I mean, some companies, it's really about how many users they're attracting. That was really about Netflix, right? No one cared about the earnings that much. It was all about how many users can they add. It's about the top line and the revenue growth. What type of growth are they seeing? So there's a lot of numbers that go into factor that, and that's just the earnings. Then you have to say, well, what's the outlook? And that ultimately that's what determines the future cash flows of the company, is how they do in the future. So you have to take all of these things into account. On top of that, there's market psychology and where the stock has been in the past. If the stock ran up a tremendous amount, or we just seen a big rally, it's a higher bar. So we've seen this big rally in the last 2 weeks. So even companies that report, they have a bit of a headwind because their stock prices have probably risen over the last 2 weeks, not because they're doing well, but overall the stock market's done well, and in a rising tide lifts all the ships. So they have a little bit of higher bar. So they have to do even better, because these expectations are not necessarily changed just because the stock market went up. The analysts are basing these numbers on their fundamental analysis, and this may be several weeks old. So you have to think about how old some of those estimates are. Analysts are not going in and changing these estimates every day. Like they're changing them on a monthly or bi-monthly type basis.
Thanks for that. Final question from our live audience tuning in right now. Thank you so much for being here with us. Now, this is more the CPI question, right? So we touched a little bit on that, but just to round up, I think going into what is a hot topic as always for this, CPI is below expectations. Now, what are the insights and what can we do as an investor as we keep a close eye on the Fed's movement?
Yeah, I mean, my thought is you have to look at inflation overall, not just one report. So it's important to look at a 3-month and a 6-month average. And obviously there's different types of number. We have, CPI number, the PCE is the Fed's number that's coming up soon. That the number that they look at the most. So you have to take all of these things into account, and then look at where the inflation's coming from and where you think that might be in the future. So my thought on that is just don't overreact to one report. It doesn't mean as much. Look at a 3 or 6 month average.
Thank you. And thank you to the audience for your questions. Great questions. And Justin, for really answering so comprehensively what was on everyone's minds. Now, Justin, before we leave you, what is your final takeaway for those tuning in right now?
I think it's reiterating what I said before is this year's not over. So don't pack it in yet. There's still going to be a lot of trading opportunities just because the Fed it was on hold last meeting. You don't know what's going to happen next. And we still have a bit of earnings season left. So there's going to be a lot of great opportunities, and really use that Moomoo app to identify those opportunities. There's a lot of great tools and features there to figure that out.
Vice President of Strategy from Moomoo Technologies, Justin Zacks, everyone. See you for our next show together, Justin, and also see you in real life soon.
Great to see you. Thank you so much.
To the audience, if you have any more questions, remember you can continue to follow us right here. You can scan the QR codes right here if you want to follow Justin on the right or myself on these pages in the Moomoo app, because these are the pages where, of course, Justin shares his insights, but you get really on top of when the next show is coming out. And also, for example, Justin was sharing about the podcasts and events that are upcoming. Everything is crafted and created just for you listening right here. So remember to follow us so that you can also catch the replay of this when it's up. Okay, so scan the QR code for more details. We can't wait for upcoming shows. Now, like Justin said, the year is not over yet, so definitely stay tuned for more content that we have for you so that you can continue to elevate your educational journey in the finance space and invest smarter. As usual, these webinars and live shows are a chance for you to connect with experts like Justin today. So we hope you learned as much as we did here from you as we continue to guide you through this. Okay, so if you want to know more about the tools that Justin covered just now, definitely scan the QR code here if you want to find out how you can use the earnings tools in the app right here. It's really comprehensive and gives you a great summary on a step-by-step pathway of how you can use the tools. Okay, so scan the QR code right now. As always, it was a pleasure having everyone with us today. We'll see you for the next one, and we wish you a profitable day wherever you're tuning in from in the world. Once again, you're with me, Olivia Higgins. Happy investing.